Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. It's been quite a few interesting developments to talk about, but I'm going to focus on two this week. The first being the clear shift in the outlook for Fed policy from Chairman Powell, and the second being the rise of Omicron, the latest COVID variant. I have Brian Daingerfield, our co-head of G10 FX strategy, with me to help piece some of this together. But first, let me recap the Powell news this week and our take on it. A couple weeks ago, we wrote how Clarida, in raising the issue of a potentially faster taper at the December meeting, was foreshadowing a more formal shift in the Fed outlook like he's done all year. This certainly came true as Fed Chair Powell's testimony this week, where he brushed aside worries about COVID and focused mainly on the upside risks to inflation that are present in the economy. He even finally dropped transitory from the lexicon, saying the Fed had not foreseen supply-related price issues that are now creating some of that upside risk to inflation. Now, I don't think him testifying in Congress as the vehicle for this shift is an accident, because the Fed is a political animal, and there's been pressure on the Fed from both Republicans and Democrats regarding rising inflation. So being more hawkish on inflation in front of Congress certainly will help ease some of that pressure. But either way, markets, which early in the week had started to fear a new viral variant, now have to adjust the reality the Fed's, in our view, more likely than not to speed up taper as long as the next few data prints come in fine. So we've talked about in the past, what the real implication here is that the markets need to think about when the first hike is. So if you end taper in March instead of June, a midsummer hike can't be ruled out as opposed to potentially starting one in September or later. So higher yields, flatter curves in the US all make sense, with spillovers happening to the other bond markets this week as well. Now, as for risk assets, they've already started to show some volatility around Omicron, but naturally also didn't like the idea of potentially tighter policy coming earlier than expected. This fits into our narrative that while I think on a medium term or week to week basis, risk assets are still probably going to be fine, they could face a lot more volatility in the next couple of weeks and in first quarter of next year in particular. The same is true for FX, which we've talked about in the last couple of weeks as well. And that's where I'm going to bring in Brian to start my questions. So, okay, Brian, you and the team shifted to a more bullish dollar approach a few weeks ago. A lot of that kind of based on our views on the Fed outlook. But what's your view now, given both Powell, which may support that in one direction, and Omicron, which presents perhaps some risks?
Well, thanks very much for having me, John. So it's certainly been, as you mentioned, an eventful couple of days here. But really, we've seen some interesting price action in the dollar, because certainly you would think that the dollar as a global reserve currency and a safe haven currency could benefit in an environment where a new Omicron variant is presenting risks to the outlook. We know from Delta variant that the outlook is already much more unsynchronized than it was at the beginning of the year and in late 2020, much more discordant. And Omicron certainly adds to that risk. But the initial reaction in the dollar, looking at the dollar index, was actually somewhat negative, because we were pricing out expectations of tightening in a lot of global central banks. Now, the last 6 or 7 months of sort of price action has all been really in the hawkish direction, pricing in additional tightening from most central banks, and the Fed being one of the leaders in that. And so the initial reaction, I think, came as dollar weaker simply because we were pricing out Fed expectations in places where they had been priced in most aggressively, including the US. So pretty interesting reaction where you have a potential negative growth shock, and maybe a significant one. I think we're all hoping that it's certainly not as bad as we all fear it might be. You have this negative risk, which on its face is generally positive for safe havens and the dollar. But at the same time, you had the market pricing out some Fed. Of course, this is where you put Powell back into the equation. And that's why it's so important what Powell said at his congressional testimony at the end of November, when he basically said, as long as the data are strong, we're going to consider speeding up the taper, which, as you mentioned, John, very important for Fed expectations. So if you look at front end rates in the US, we took out quite a bit in the 2-year note, for example, fell maybe almost 20 basis points at one point. We've recovered a lot of that, but the dollar really hasn't moved back higher, even though you've seen a reflattening of curves and some higher yields in the US. So I think this continues to point towards a stronger dollar. Certainly, I think the risk case to that would be if Omicron turns out to be worse than Delta, more contagious, vaccines are less effective, then you have to start thinking about services-led economies and how services-led economies could come under threat from reintroduction of lockdowns and new restrictions. And that's an environment where the US and other services-based economies could see more persistent risk. But for now, we think the dollar likely continues to perform well. You mentioned that this is probably going to be a volatile environment where we're trying to balance a lot of different themes. We're trying to balance inflation, COVID, the impacts of Omicron variant on inflation, on the Fed. We have a Fed that's signaling that they're not changing course simply because of the risk of Omicron at this stage. So we're balancing a lot of things that probably points towards a somewhat volatile period. And as we know, periods of volatility tend to be beneficial for the dollar as well. So still feel like that's probably the base case here. But I think we're all looking towards how effective are vaccines against Omicron and how significantly does the global outlook need to change in light of this new variant.
Yeah, I think you make a good point, and it should be a reminder to me here that we still do have a couple of weeks till that Fed meeting. So Omicron developments in theory certainly is a risk, even to what Powell just said, that they're likely to accelerate taper. I mean, in the back of my head, I just think that if they're, and again, nobody wants this, but if you have a lot of headlines about cases and hospitalizations and restrictions going on in the United States, it feels like it's going to be hard for the Fed, again, a political animal, to necessarily just all of this, let's just say the decision to accelerate the reduction of monetary accommodation might be a little bit more tricky. So shifting geographies a little bit, we also have, ECB and Bank of England the same week of the Fed, not this coming week, but the week after. The ECB meeting is a lot less contentious, I think, but how do you think this could influence other central bank decisions? We haven't heard as much from, say, like Bailey and crew since Omicron's come up.
So certainly from the central banks we have heard from, as you mentioned, the general sense has been that this is a risk to the outlook, not a game changer for the outlook. That feels very appropriate in the US, where we've only recently confirmed the first case of the Omicron variant. But in Europe in particular, you have seen much more significant case gains. And with it, you have seen travel restrictions come back into place. And I think Europe in particular, less so the UK, but Europe, I think, starts from a lower baseline in terms of growth. And so the negative shock needed to push the ECB in a dovish direction doesn't need to be as large as it does in the US, where Fed and the Fed and Chair Powell likely need to see a much more significant hit to growth to turn in a much more dovish direction than the ECB does. So I would look towards the ECB in particular. We know that they're in the process of figuring out what happens at the end of PEP, the emergency asset purchases. How does that transition into the asset purchases, into a sort of a regular program? We've already seen some sources report suggesting that the Omicron variant and the risk to growth there might complicate some of that signaling. So the ECB is the one where I feel like maybe, at least from a signaling perspective, what does Lagarde say about growth and the need for the ECB to stay accommodative and really to push back hard against tightening expectations in the market? We know Lagarde already has been pushing back against those expectations, probably has a little bit more room to push that narrative, given the significance of case growth that we've seen. And for the Bank of England, I mean, it's the December call was already an extremely close one, I think. This is only going to add to what I think has already been a challenging picture, where they're trying to balance external drivers of higher inflation against internal challenges. And so it was a very difficult one to call in November. It's a difficult one before Omicron, and certainly going to be a difficult one now with a new negative driver being thrown into the mix.
And just one last quick question, which I'm going to ask you to stand in for Alvaro and Galvin and the rest of the EM team, but none of this, either way, sounds very good for emerging markets, does it?
No, it doesn't. And as I mentioned at the onset, for the dollar is actually not performed. It's actually weakened against some currencies, including some emerging market currencies, as the market has priced out some Fed. Now, pricing out Fed tightening expectations, even independently of Powell, who kind of put them back on the table, pricing out of any Fed and reducing the risk of a significant Fed tightening cycle That's good news for emerging markets as sort of an instant reaction, but certainly nothing about Omicron is good for global growth. It's nothing about it is good for the world by any means. And that's certainly the case across emerging markets as well, where you have the Fed and other central banks in developed markets probably have room to maybe signal guide towards less aggressive tightening cycles if the Omicron variant turns out to be quite weak, quite poor for global growth. Emerging market central banks probably don't have that flexibility simply because inflation is already starting from a much higher baseline. And so you have a variant risk that could be particularly negative for emerging market economies where vaccination rates are already lower than they are in developed markets. You have central banks that are tightening for what we call the wrong reasons and may be forced to continue to do so, even if other central banks in developed markets where inflation targets are more cemented, inflation expectations are more anchored, those have room to maybe slow down a bit if this turns out to be much worse than we all fear. So for emerging markets, the initial reaction, because we've priced out some Fed, has been a bit more mixed. It's not been purely negative, but I think the outlook is still pretty challenging. That's what we were thinking going into the year ahead for 2022, and Omicron variant really kind of adds to that. Doesn't take away from that view.
Yeah, challenging indeed. All right, well, thank you, Brian. Really appreciate your insights. And thanks to everyone for listening. That's it for this week. Unfortunately, we're recording before the U.S. jobs print, so our comments on that report, how it might influence the Fed and everything we've discussed, we'll have to wait for next week. We're also keeping an eye out, obviously, for more developments around the virus, but we do get U.S. inflation data, which will be important for the Fed. And also, we'll look forward to the Bank of England and ECB meetings in next week's Weekly Watch. Thanks for listening and have a great week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.